you can start off by risking like $2, $3, $1, something like that, right? Start small. Don't expect that you can put in $10 tomorrow and then after like 1 day or 2 days you already have $500. It's not gonna happen like that.
Hi friends, this is Courage from Trading with Tani, and I'm so glad that I was invited here to give you a complete beginner's guide to Forex trading. So in this course, I'm going to teach you what Forex trading is all about, how to get started, and how do you make money in the Forex market. So without wasting much of your time, let's get into the course and let's get started. So the introduction to Forex trading for beginners is all we are here for. So we are going to try to get all the basic knowledge that you need to start trading on the Forex market. So I think this is going to benefit like people who know nothing about Forex, people who have maybe just start hearing about Forex trading, maybe from Instagram, Facebook, maybe from YouTube, but you don't really know what Forex is all about. So I'm going to try to make sure that I explain all the details of what is Forex and how it works. And also, if you have some experience, let's just say you have a little bit of experience, you've placed some trades, maybe you've made money, maybe you've lost money, but you feel like you've skipped the basics, this is going to be also for you. And if you are experienced, maybe there are going to be some semi-experienced people here. You can even stick around because later on I will go to the basics of how do you analyze the markets, and I think it's always good to understand the basics. But if you are really experienced, also if you're just looking for a strategy, then maybe this is not gonna be a good one for you, because we don't want to waste your time if what we have is not what you're gonna get, right? So, but if you really want to start again and learn, here's what you're going to learn. Number one, what is Forex trading? How do traders profit? What are currency pairs and currency codes? What are pips and lots? Here we are talking about how do you calculate your profits and losses in the market, right? And also, we are going to talk about Forex brokers and how to choose a good broker. I'm not going to recommend any broker, but I'm just going to talk about how do you choose a broker. And then I'm going to try to show you some live trades from my if I can switch to my phone, I'll try to show you some live trades, right? Then also introduction to technical analysis and some questions and answers. I'm gonna try to answer some of the questions, the basic questions that I always get when people are talking about Forex trading. So let's get started. Let's start talking about what is Forex. Forex is just a word which simply refers to the foreign currency exchange, right? So the foreign currency exchange is an exchange market, right, where people buy and sell currencies with different reasons, right? For you as a trader, your main reason is to make profit, right? But for some people, it can be different, because if you think about, let's say you live in Nigeria, right, and you want to go maybe to another place, maybe to South Africa, you find out that you are forced to exchange your naira or your US dollars to South African rands, because you cannot go and use your US dollars in South Africa, right? So you have to exchange currencies, but you are not doing this for profit, but you are participating in the market somewhere, somehow you are affecting the price, right? And also for other people, like let's say companies, maybe a company in Japan who want to buy some parts from the United States of America. So what do? They will exchange Japanese yen to United States dollars. And as this happens, there is an exchange market, which is the biggest exchange market in the world, right? There's $6 trillion being traded each and every day. So there's $6 trillion worth of transaction that is happening each and every day. So this is a screenshot right here that I took from one of the banks in my country, right, in Zimbabwe. So the exchange rate for exchanging different currencies, if you can see here, you can see that there's US dollar here, which is written here. I don't know if you have been ever to a bank and if you know how to read this exchange rate board, right? So this means $1 US. If you have $1 US is equal to someone who has 1.11 for euro. So I'm going to explain this in much more detail in a minute, right? And what this simply means is, if you have another currency that you want to exchange with the currency that is here, that is the rate that they give you at that day, right? But if you have ever been in any market, you know that these exchange rates, they are always changing, right? Sometimes you are going to hear that, okay, $1 is 500 naira, but after like 1 week, you can hear, okay, now $1 is now 700 naira, and this exchange rate is always moving. So with that movement of the exchange rate, you can make money in the market. But so let me show you how do you profit in the forex market, right? So I'm gonna take that exact same exchange rate, right? And we are going to use South African rands here. I think it's the easiest for you to understand if you are just starting out, right? So this exchange rate simply means if you have $1, because the US dollar is written here on top, so it's called the base currency. It's the currency that we have, that each and every currency that is down here is compared to this one, right? So $1 is equals to 15 rands, right? $1 is equals to 15 rands, right? 15 South African rands. So that simply means if you buy 1,000 US dollars, you are going to use 15,000 rands, right? So this is not the exact number here, but I'm just doing this so that you can understand, right? So let's say you buy at this number right here, right? So you use 15,000 rands to buy 1,000 US dollars, right? And then maybe you hold this 1,000 US dollars. This is gonna be happening automatically, but of course you need to understand what's going on. So you hold on to this US dollars and you use 15,000 rands to buy this. And then maybe 2 days later or 2 hours later or 3 days or maybe 1 week later, the exchange rate, this exchange rate right here can change maybe to 16 rands. Now, $1 is now equals to 16 rands, right? So that means you have $1 that you bought with 15,000 rands here. So if you go ahead and sell that exact 1,000 US dollars at 16,000 rands, right? Because at a higher rate now, you can be left with 1,000 rands in your pocket, right? Because if you think about this, firstly, you buy with 15,000 rands and you go to 1,000 US dollars and you hold that, and then the exchange rate goes up to 16, and then you sell that same $1,000 and now you get 16,000 rands, right? So that's the math behind the profit, right, of forex trading, right? So there are two ways of profiting in the market, right? The first one is buying low and selling high, right? So when you go into the market, into your trading platform, you're going to be seeing these candles right here, right? So these candles, these are called candlesticks. So we're going to talk about them later on. But this is what represents your price, right? If you look on this far left, far right here, you are going to see there is these numbers here. You can see that from this point right here, you can see to this point, what is happening here is represented here. So these numbers here shows you where the price is, and these candles here shows you where the price was. So at this point, that simply means the price was this one, and at this point, that simply means the price is this one. So what is here is representing the price, which is on this far corner, right? So this price, as you can see, this is the 4-hour time frame, right? For this example, is 4-hour time frame. So after every 4 hour, one of these candles is created. So that means in 4 hours, right? So here in 4 hours, right? So if you count 1, 2, 3, 4, because after every 4 hours, this one of these is being created. So in 4 hours, the market moved from this point. The exchange rate moved from this point to this point. So you can see it's a big movement right here, right? So if you were at this point and you know or you predict, right? You are not going to know, but you are going to be predicting based on technical analysis, and some will do fundamental analysis, right? So if you predict that, okay, this price is gonna rise and you buy at this price here. If the market goes up like it did right here and you sell at this point, you would make the difference between this number to this number, right? So let me make this clean. So you make the difference from this number to this number, right? If you predict that the market is gonna go up and it surely goes up, right? So that's how it works, right? That's buying low and selling high, right? I'm going to show you another example. There's sell high and buy low. So here's another example. Let me move this here, okay? So you can see that from this point here, the price moved from 0.9215, right? We are going to understand this. Of course, it sounds a little bit confusing at first, but you are going to understand this very, very soon, right? And from this point, the market moved all the way down to this point. So if you had predicted at this point that the market is gonna drop and you sell, right, whatever you sell, right, you whatever amount, because I'm gonna show you how to calculate the amount, but whatever amount you sell here, if the market goes down, you are going to be in profit because you predicted that this market is gonna drop, right? So what drops the market and what rises the market? It's the different factors like the economy of countries or the market itself, technical analysis, other traders participating in the market. There's a lot of things, right? Some of them are government related. There's a lot of things that moves this market, but your job is just to predict, is this market gonna go up or is gonna go down? If you think it's gonna increase, going up, which is increasing value, right, for the currency pair, you buy. If it goes up, you make profit, right? So it's like, let's say you buy a house at $10,000, right? So let's say you buy a house at $10,000, right? After maybe a market crash, you buy a house at $10,000, and then the real estate or the house market goes up in value and your house increases in value. Maybe for some reasons houses are getting expensive and now your house can be sold at $50,000. You can sell that and take $50,000, right? So that's like buying the currency at a lower price and then it goes up. So this movement happens every day, all day, right? So on my example, I was talking about the banks and all these things, but you don't have to go to the banks. You're going to be doing this on your phone, right? I'm going to show you what happened. But first of all, let's talk about what is a currency pair, what are we buying and what are we selling, right? So a currency pair is a pair of two currencies, right? Two currencies that we have. For example, here we have the GBP USD, right? GBP stands for Great Britain Pound, and USD is obviously the United States dollar. And then we have the exchange rate here, right? So what does this mean? We have what is called a base currency and a quote currency. This means one Great Britain Pound is valued at 1.5125 United States dollar. So if you have 1 pound, you are equal to someone who have $1.5. So it's equal, right? So that means if the pound gain value, right, the US dollar is gonna lose value, right? Because if this one loses value, because if this exchange rate changes to 2.1, that simply means the United States dollar have lost value against the pound, right? So what you are buying and selling is just money. You are just buying and holding another currency pair and hope that another one loses value so that you can sell back and make your profit, right? So the first currency pair is called the base currency and it always equals to 1. So it's always equals to 1, right? And the quote currency is the one that moves up and down. If you think the quote currency is gonna lose value and move up, you buy the base currency. So that when the quote currency rises, right, you are in profit and then you sell back and check the difference of the movement, right? If you think the quote currency is gonna drop in value, you are going to sell, and then if it drops in value, you are going to make money again, right? So think of it like, if you buy one share of Facebook, maybe a Facebook share is $100, right? Just an example. And if you think Facebook shares are gonna rise in value, are gonna go higher, you just gonna buy Facebook shares, right? And if the company keeps going in a good direction and makes profit and all those things, and the share rises, if it rises to 150, you can sell and then make the $50 difference, right? So that's what this is all about, right? So it's very, very easy to understand, but at first, it sounds kind of hard. That's why I try by very, very much to explain this to you, right? So now, this exchange rate right here, you need to understand how it works, right? So you do this by understanding what are called pips, right? So this is where you calculate exactly how much money are you going to be making per movement, per the size of the movement, right? So you need to pay attention now, right? And by the way, you might be thinking, okay, you was talking about buying $1,000, $10,000. I need all that money to start trading. No, what happens is we're going to talk about that. But what are called brokers? Brokers, what they do is they just say deposit like $20, and then you can be able to buy higher amounts of money with what is called leverage, right? And what does the broker have to lose? The broker will not lose anything. The broker will say, okay, whatever you buy, we're just going to add the profit or deduct the profit directly from your account. So even if you even if you have $100, you can trade $100,000, but the profits and losses are going to be added or reduced in your account, right? I'm going to explain that in a little bit, right? But first, let's talk about what are called pips. So a pip is the smallest movement that a currency pair can make, right? And a pip also. So let me show you this. Uh, when you're talking about money in the streets, right? What happens? What happens when you see something like this? You are going to just say this is $1.20, right? But in Forex, what happens is there's also another two numbers that are coming after the 20 cents, right? So this is $1.20, and there's these two numbers that are less than a cent, right? These are the most important numbers in Forex trading because this is where you make money. This is what moves each and every day, and that's how you make money. So the dollar can be the exchange rate for the banks or for everyone else can be $1.20 for 1 year, but there is these two numbers that is always moving. That's where traders are okay all about, right? So you might say, okay, so how do I make money? The uh, the exchange rate never move. I just know the exchange rate has been the same for 2 years. No, we care about these two numbers that are here. They always move. Each and every second, it's moving, right? So if you look at this, you're going to see these are called exchange rate. These are the currency pairs here, and here are the exchange rates, right? You're going to see here it's $1.3756, $1.17 95, right? So this 40 decimal number here is the smallest movement that you will make, right? And if this number changes, right, so you're going to see the exchange rate will be like this. If this exchange rate changes maybe to 1.2026, right, what is the movement right here? If we subtract this number from this number, you're going to get 0.0001. That means our currency pair have moved with 1 pip, right? It's called 1 pip. So 1 pip is always 0.001, right? So if this move to maybe 20, let's say let's do this so that you can understand this. So if this move to 28, right, the exchange rate moves from 1.2025 to 1.2028. we subtract this number from this number, and we are going to get a 3 right here. That means this market moved with 3 pips, right? And these 3 pips can be either $3, it can be either $30 or $3 in profit or in loss, or 0.30. And this happens because depending on how big is your trade, right? And I'll explain that in a minute. But these 3 pips, because this is a small movement, this can happen in less than 5 seconds, right? But someone can actually make $30, $3, or 30 cents, depending on how big your trade is, because there's what is called lots, which we are going to talk about next, right? But now you need to understand that the 40 decimal number is the pip, right? And if you want to know how many pips the market have moved with, you just want to subtract the new exchange rate, the old exchange rate from the new exchange rate. So let me show you one more time so that you can really understand this. So if this exchange rate right here, okay, let's take another example. Let's take this exchange rate here for Euro USD. Euro USD currently, it was on 1.1795. So if this exchange rate, if I buy this exchange rate at this Euro USD at this exchange rate, which is 1.1795, forgive my drawing here, and if it moves to 1.17, let's say 99, okay, or something like that. So if we subtract this, we are going to get 0.0004. That's 4 pips that we have, that we got in that market, right? And the pips, it comes all the way here. So if it moves to, let's say here to 1. Let's see, if we put 8 here, that simply means this number is gonna change. So it can be like 14 pips. I'm not calculating here, but I'm just saying, right? So it adds. So if this is 0.0001 pip, this is 0.0010. So this is now 10 pips. So you just subtract here whatever you get. If it gets to like this is now 100 pips. And this is 1,000 pips, and 10,000 pips now is you will be changing now on this value here, right here. So this is not very important, but I'm just saying so that you can really understand. So let's move on to calculate on how the profits are made based on these pips, right? So there's something called lots, right? So you probably heard me talking about buying thousands of dollars, and I said you don't need thousands. What happens in the Forex market is there's what are called lots. Lots are units of currency that you buy or sell at the same time, right? And there's 3 types of basic lots that people use. There is a standard lot, which is 100,000 units, right? If you buy one standard lot, you are going to be buying or selling $100,000 or 100,000 euros. So just say 100,000 units of a currency pair. You can buy this with $100, but I'm going to explain to you what are the advantages and disadvantages of buying huge lot sizes with a small account, right? So there's also what is called a mini lot. And there's what is called a micro lot, right? A mini lot is 10,000 units, and a micro lot is 1,000 units, right? If you open your trading platform for the first time and you will try to place a trade, you are going to see a picture, like a screen like this, right? This is a screenshot, but you're going to see a screen like this where you select your lot size right here. This lot size here determines how much are you going to win, how much are you going to lose, or at the trade, right? So this is how it works. If you place one standard lot, right, you are buying 100,000 units of any currency pair, right? And if it moves by 1 pip, you are multiplying this 100,000 units by 0.001, which is the 40 decimal number. And I'm going to show you what I'm talking about in a minute. So here is where you change your lot size here. I'm going to show you this, and also, so let me try to be fast. Let me move on to how to calculate this pips and lots, right? So pip value per lot simply means how much money are you going to make per pip depending on your lot size, right? I said if our market moves from 1.2025 to 1.2026, it has moved by 0.0001, which is one pip, right? One pip, okay, it's written here, one pip, 0.001, right? And if this one pip here, if we get the one pip movement, it can happen in a second. If we are using a one standard lot, right, which is 100,000 units, that simply means we just have to multiply our amount that we bought with one pip, and we get $10 per pip movement, right? You don't really need to you are going to be calculating this when you are calculating stop losses and take profits, but now you just need to understand that the value per pip, we just multiplying the number of pips that we get with our lot size, right? So what happens is, if you are buying 100,000 units of currency, right, we are saying on each and every pip movement, I need to win or lose $10. So if I get 10 pips times $10 a pip, that's $100. 10 pips can happen in 10 minutes or less. 10 pips can happen in 5 minutes, maybe. So that's why you hear people saying the Forex trading industry is the easiest industry to make money. And unfortunately, I didn't start off with talking about the mindset and some things like that, but I think I would need to get like 5 minutes to really make sure that you understand what you need, what you are going to be going through as a trader, right? Because when I'm talking like this, it's gonna be very easy for you to just decide, okay, I just want to start trading right now because this guy is talking about easy money, okay? So I will try to make sure that you understand really what you are going to be going through before before you decide to start trading on your own, right? So lot size, as I said, is just the amount of money that you are buying and selling at one point, right? So now there is something called the bid, ask, and the spread, right? The bid price is the price that you are going to be, the market is willing to let you buy it, and then the ask price is the price that the market is willing to let you sell it, right? So if you see these numbers, you are going to see some are different, some are the same, which means there's a small, very small spread. Some are big. You can see here, this is 95, this is 97. So if we subtract here, we're going to see there's a 2 pip spread here. So the spread is the difference between your buying price and your selling price. So if you buy here, that means you are going to start with the negative 2 pips. So if you are using a standard lot, if you are buying 100,000 units, that simply means if you sell here Euro USD, you are going to start off with negative $20 already, right? It's the spread. So what is the spread? The spread is the commission that the broker takes on each and every one of your trades, right? So these spreads can differ from brokers. Some brokers have very tight spreads. Some brokers and the spread will change depending on the market time. Sometimes the spread is very limited. So you need to keep an eye on that when you are trading. You need to know about the broker, because maybe you might be having $100 in your account, and then you place a trade. You don't check that there's a 5 pip spread. That simply means if you are risking like $10 per pip with a standard lot, you are already minus $50 without your trade even going anywhere. So you need to keep an eye on the spread, right? So the difference between the bid and ask is the spread, right? So you need to just know, sometimes just check, okay, I need to trade, but the spread is too big, so I will not trade. So it's good that way. So that's why I just brought in this. So the broker will take a commission for for you using their platform, and for you using their leverage, because they will give you leverage to buy big, to trade big, even if you have a small account, right? So let's talk about brokers a little bit so that you need to understand, right? When you are trading, you don't go to the banks, you don't go to the change centers. You just download an application, sign up for a company. They will need your most of the time your ID, and then you just need your ID most of the time. But to create an account, most brokers just create an account, and then once you create an account, you deposit a little bit of money. You can start with a demo account from the broker, right? So this company, it's just there to connect you and the market, right? So there's gonna be you here, and there's gonna be this company, and then there's gonna be the market, right? So if you want to buy and sell, let's say you look into a trading platform, right? And you think, okay, this exchange rate can go higher, right? According to your analysis, according to whatever you are going to learn here or wherever you are going to go, right? When you want to buy, you can't just access the market. You go through a broker. So you create an account with this, right? So back in the days, they say the brokers you were going to be you would call the broker, and the broker were local, so you would call the broker and you tell them I want to buy. So nowadays you just go into their website, you create an account, you connect your account with a trading platform, right? And when you want to buy, you just open your trading platform and you buy. Your trade is gonna be placed automatically, and your money is gonna be is will be adding or subtracting from your account with the broker, right? So you create an account with the broker, and whenever you place a trade, the broker will put your trade to the market, right? So let's say you buy, the broker will find someone who wants to sell into the market, right? So it happens automatically in a split second. You um the broker will find, if you want to buy, the broker will find someone who want to sell, or some brokers will act as the other side of the market. So that means when you buy, they'll also give you the liquidity to just buy directly on their platform, right? So when you want to sell, the same thing happens. So it's you, the broker, and the broker is the intermediate, right? So it's the company that is between you and the market, right? So I hope that you understand that. So when you are choosing a broker, you are going to be creating an account, right? So if you are creating an account for whatever you are doing online, whenever you create an account that you are going to put your own money, your own details, you need to find someone who is trusted, right? So when you are choosing a broker, these are the things that I think you need to understand, right? Number one, know about the broker, ask around, look for reviews, things like that, right? But when it comes to trading and making money in the market, you need to look for things like leverage. How big is the leverage? If you want too much leverage, but leverage, I will explain it. What is leverage? Leverage is, so I said, if you, let's say you have $100 or you have $10, right? Let's start off with $10. Let's say you have $10, but you want to buy 100,000 units. So I only have $10, but I want to buy, because if you look at okay, I'll do that in a second. If you look at the exchange rate that I was showing you, and that I will show you, you're going to see that this exchange rate, they doesn't move. I said it can move with 2 pips, 5 pips, or maybe at most up to 100 pips per day, right? So if I buy $10 of this, because we were saying 100,000 times, so we were saying 100,000 times 0.004. Okay, it's 4 zeros here. That means we were going to get $40 here, right? Because if you say 100,000 minus 0, okay, times 0.0004, you are going to get $40. But if you say 10 times 0.004, you are not going to get any reasonable profit here. So what the broker does is, the broker will say, give us a fake deposit, whatever you can afford, right? And then you put it into your account. and then we allow you to trade as much as you want, as big as you want. But the profit, because here's the catch here with leverage, right? The broker will say, okay, you have $10, so you can buy all the way maybe up to $1,000, right? So they'll say our leverage is times. They'll just tell you that our leverage is times 200, right? Which means whatever amount you have in your account, you can trade up to 200 times that, right? So if this is, if I have 10, if I have $10, if I choose times 200 leverage, it means I can be able to trade up to $2,000. So I can buy 2,000 of this. And if I buy 2,000 of this, so if I buy 2,000 and the market moves with 4 pips here, I will make what? Right? I will multiply this by 2,000 and I will make something like 20. This will be like 4 pips. It will be something like 40 cents, right? So instead of making $40 now, I'm making 40 cents, right? Because I have a small account, which is only $10. So if I have 100 and they give me $200, 200 times 200 leverage, they allow me to, they are allowing me to trade up to 20,000, right? So now instead of making 40 pips here, if I use 20,000, it's gonna be bigger, right? Something like maybe $4. So my math might not be good here, but I don't think it matters because when you start trading, you're going to see this happening in the trading platform. These days, I think we are lucky that technology will do all the hard work and calculating for you. All you just have to do is know what you are doing, right? But the important thing, calculating pips is very important. Knowing, okay, this is gonna be 40 pips. So how much is it in dollars? It's gonna help you very, very much. So number one, you choose the leverage. Some people will choose bigger leverage. Some people will choose less leverage. But I always try to say go lower on the leverage. Don't try to over leverage because the bigger you trade, because what I was saying is, let's say you have $100. Okay, one more time. Let's say you have $100 and you are trading a bigger leverage and you are trading all the way to 100,000 units per trade, right? If you do 100,000 units multiplied by 1 pip, if the market moves with 1 pip, that's $10 per pip, right? So the broker will say, okay, buy whatever you want, but the profits that you are going to get or the losses, because if you predict that the market goes up and if it doesn't, if it goes the other way, what happens? You lose money because you are losing the value, right? So you can make money or lose money here. So if the broker says, okay, buy as much as you want, but the profits that you make or the losses that you go through, we are just going to directly subtract in your account, right? So that means if you are risking or if you are trying to make $10 per pip, if you have $100, if the market goes up by 10 pips, you are going to double this account. You have $200 maybe in 10 minutes, and people will say, okay, Forex is a get rich quick scheme because I can make 10 pips and double my $200 account in 10 minutes, right? Some will come to you on Facebook and say, give us $100, we'll double it in 10 minutes. What do? They'll just risk all your money on one short trade. If it goes in their way, they will make a lot of money, but I bet you it's not always gonna go your way, right? Because there is the other side here. That's why leverage is dangerous. If you over leverage, if you place a very big trade, only 10 pips, you can double this account or you can lose this $100 with that 10 pips. Because if this 10 pips goes your way, you make money. So you can double your account in 10 pips. But if it doesn't go your way, if it goes against you, you are losing $100. So what is easier for you, to lose $100 or to make $100, right? So for me, I would say, okay, let me try to make $2 or $5 or $1 per pip. So with 10 pips, I I will be making $10 profit, right? If it goes against me, I will be losing $10. It's better that way because I still have another $90, right? So over leveraging is dangerous because the bigger the leverage you do, the bigger risk you put yourself into. So check the leverage and also check the spreads. Different brokers take different commissions. Some brokers have tight spreads, so it's better to trade with tight spreads. And then this is the biggest one for everyone in Africa. Whatever business you want to go online, we know how hard this is, right? For me personally, I think this is the hardest part of my life, trying to figure out the payment methods of doing things online. It's very, very hard. So you can go ahead, sign up with the broker, and you like them, everything's going well. But when you try to put money into your account, or when you try to withdraw money from your account, then you find out that the broker doesn't support your banking system and you cannot take money out or you cannot put money into the market. And I think this is the biggest problem at first when you start trying, right? But luckily nowadays there are brokers, right? So I don't really want to recommend brokers here because this video, okay, it's not like sponsored or something like that, but there are different brokers you can go. There's what is called there's a broker called Deriv, right? This is the one that I use. I also there's a broker called XMS, right? XMS. There's a broker called HM broker. There is a broker called what is this name of this broker? They always advertise to me. Okay, I'm forgetting about that broker, but I always see there. There's something called what Forex, right? These are all brokers that you can go for. For me, I chose Deriv. Why? Because Deriv have got a feature or where you can they have a peer-to-peer feature, right? If you know anything about crypto, there's a peer-to-peer feature that is happening where you can exchange money with other people without the interference of banks or things like that, right? So if I can just send money to you and we can do our transaction on a peer-to-peer platform, that's why I chose Deriv because payment methods is gonna be a big problem, and I know that, right? And also there's customer support, right? There's customer support when you are trading or when whatever you are doing with money, you don't want to give your money away to some people who don't respond to your messages or your queries, right? So check the customer support and also check the experience. How long has been the broker in the market? Because if you think about it, this forex industry is too big, and if the broker is not legit, it doesn't take long for them to get exposed by someone and go out, or even to get to go broke. So you don't want the broker to disappear with your money. But if you find a broker which has been in there for 10, 15, 20 years, somehow you feel that, okay, this is a little bit trustworthy broker, right? Now, these are the basics. So what I want to do, guys, I think we have been here for 50 minutes already, okay? But you are going to be with me, guys. I think we are going to go over an hour here, but I want to go into my phone and then I want to place. Okay, I want to place some trades in front of you so that you can understand what is going on, because you can understand all what I'm talking about here. So I will go. Let me
Do is I want to try to share my my phone screen here, but okay, I think it can happen. Man, Telegram is 10 times better than WhatsApp.
Yeah, that's Telegram has more features than WhatsApp.
I don't know. I don't know why. I don't know why most people more people are not on Telegram, but Telegram is very much better feature. So tell me if you can see what I'm doing here.
Yes, I can see your screen.
Okay. So I have so I have this so this is an account one of, let me see. Okay, so this is one of my accounts which have a few dollars in there, but things haven't been good for me today, so I need to stop trading and move into something. So I want to go into a demo account here so that I don't risk because I'm gonna be placing some big trades here. So that you can see how it's going. So I want to try to log in a demo account, not in a real account, so that I don't risk my real money, man. But so the demo account and the real account, they work the same, but the difference there is on a demo account you are not risking your own money because this is it's gonna be some practice money, as you can okay, I think yes, this is a demo. As you can see, it's labeled here demo, right? So this is the chart. Let me change color to white so that you can see this. Uh, okay, okay, okay. So let me just do this. So if let's say you want to place your trade right now, you can see there's two lines there. There's a green line. There's a red line. The difference between the red line and the green line, you can see that's the spread. That's the spread that I was talking about. So when I place a trade here, we are going to see that um, we are going to see that my trade is gonna start off on, whenever you place a trade, it's gonna start off on a small loss, right? So what I want to do here, these are the currency codes that we have, right? So this is where you choose your whatever you want to trade. So let's say I want to trade Euro USD, which is the most traded pair in the world. So let's just click there and go to the chart. You're going to see the chart which looks like this. So the charts, I'm gonna go and explain about charts in a minute, but right now let's just assume that we want this exchange rate to go up, right? So you can see that it has been going down for a long time right here. So let's say right now, according to any kind of analysis that you can think of, let's just assume that we are thinking that now this chart is gonna start to rise again, because you can see here it has been rising, and then it started dropping, and now let's just assume that we think that it's gonna rise again. So we are going to click on this button here, on the corner here. You can see you click there and you come to this page that I was talking about. So now this account, okay, in a minute, real quick. This account right here is the account from your broker, and this platform here that I'm using is called MetaTrader, right? MetaTrader 5. This is a trading platform. This is where you analyze your market. This is where you place your trade. But this account here, you connect to your broker's account. So if I click here, right, and if I click on this plus sign, just real quick so that you can understand what's going on. If I click on the broker, I can see I have two brokers that I use, as I was talking about. There's Derif Limited, there's 8K, right? So this is another account, this is another account. This is another account also, but this one is a funded, it's story for another day. This is a funded account from a company that funds traders, right? But there's 8K, there's Derif, and then there's MetaTrader. So the last one is for MetaTrader. So let's say I wanted to connect my Derif account. I will just click on Derif Limited, and then I will put when you create your account, they give you a login ID and then your password and then the server, and then just add here and you click log in. Once you log in, you are going to be logged into an account which looks something like this. So I'll just go here, and so let's say we already created our accounts, right? So you just click on this plus sign. Let's say we want to, we think that it's gonna rise, right? I said we think that this is gonna rise to the upside here. So let me get this quick. So let's say we think that this is gonna rise to this point, right? Uh, so let's say we think that this is gonna rise to this point right here. So we want to buy. Remember, I said if you think the exchange rate is gonna rise, to buy so that you, your base currency is gonna gain value, right? If you think it's gonna drop to sell, so let's just say we buy. So I will buy. Okay, so real quick, okay, guys. I almost forgot. The weekend is already started. So this exchange rate are not moving. So let me move on to another account. So currencies, when you are trading currencies, you are going to be trading for 24 hours a day for 5 days in a week, right? For 5 days in a week, you are going to be trading. You are going to be trading uh, for from Monday to Saturday. Sorry, Monday to Friday. Then Saturday and Sunday, the markets will be closed. The exchange rate doesn't move. But there is other markets that is just the same as Forex. For example, this is a real account. I'm not gonna place big trades here because it's my real money. So I need to be careful with it. But this market is always moving. It's a synthetic market. So let's just say I want to buy here, and we think that the market is gonna go up. So I'm just gonna randomly buy. Right? This is dangerous, but I'm just gonna do it. Okay, done. So once I do this, you're going to see this is the account, right? So this is the trade that is running, which is written step index right there. So right now I'm 40 cents in loss, as you can see. So this 40 cents in loss simply means this is the spread. So I started off at 30 cents, 40 cents in loss. This is the spread for the lot size. So if you can see, right, let me do this. Let me go to this right here. So on the phone, I don't know how to draw right here, but you can see it's written zero right here. Right here, you can see it's written 0.10. That's the lot size. As I said, right? The lot size can be if I write one here, if I write 1.10 or 1.00, it simply means in the current market I will be risking $1 per $10 per pip, right? Each and every pip movement, I will be risking $10. But I'm putting 0.10 simply because I want to risk something like $1 per pip. Right? As you can see now, when the screen is red, you are still in loss. When the screen is blue, you are now getting into profit, right? So as you can see now, I have like 40 cents, 20 cents, 30 cents here. You can see 30 cents, 40 cents in profit, right? So right now, as you can see here on the balance, it's $178. That's the money that is in this account. And then we have the equity. So the equity is this money that is floating here, 20 cents, 10 here, 20 cents, 10 cents, 30 cents, right? That's the equity. So the equity is the balance plus the profit or loss. As I said, the broker will say, but you will say buy whatever you want, but the profits or losses we are going to calculate from your account. So right now, as I go to loss, you are going to see my equity dropping, which means the amount when I close the trade, whatever equity I have, that's the money that I will have, that I will have in the account. So it's either balance plus profit or balance minus loss. So if I close this on a loss, you are going to see that. Let me do this. Let's just let it. Just wanted let it go to dollar so that you can really see what's going on. But this is the account. This is what is happening. So if I close with profits, my account, the money that I close with is gonna be added to the to my balance, right? So what I will do here is I'll just let it. Okay, let me just close it because this is just a guess trade. But let me go to the chart real quick. You can see here. Sorry. You can see there is a sign code which is saying buy here. Buy 0.18 at this price right here. And you can see I bought, but the market is going against me. So what does this mean? This means I'm losing money here. 80 cents, 90 cents, 70 cents, because the market is going against me. But if I buy here, and if the market goes in my direction, right, as you can see now, it's going against my direction. But if I buy and if the market goes in my direction, I'll be profiting. Here I'm losing like $1.70 now. And if the market goes up, I would make profits. But now it's going against me, right? So this is a live trade, as I was telling you. So this is what is gonna be happening. Now it's around $2, right? So I'm gonna close this so that the losses doesn't go really big, because this is not a planned trade. You need to plan your trades. You don't just trade, right? So I'm just gonna close this with a $1 loss. Right? So it doesn't matter if you are a trader. If you get used to it, you won't freak out to closing a trade with a $1 loss, right? So if the market goes in my direction, I would make profit. But as you can see, as you saw, the market was going against me, right? So, and the good thing that happened right here is we took a loss in front of you guys, so that you can see that the market is not always about making a lot of profit, right? Sometimes the market will buy, you think, okay, it's going to go higher, right? Of course, here we didn't do any analysis, so it was against the trade. But if the market goes in your direction, you make the profits. If the market goes against you, you make the loss. So I will just jump back to the computer so I can show you, so I can be able to show you how to analyze the market and predict the right direction of where the market is likely to go, right? So it's not going to happen 100% of the time. Not most of the time, but sometimes you're going to get things wrong, and the market is not going to go in your direction. So there's things that you need to learn on how to manage your money, how to put your stop losses, some things like that, right? So I think we are going to add on that, right? So let me try to jump back to the computer and
Okay, so I'm now on the computer and let me share screen again. So, okay, now fine. Now let's talk about technical analysis, right? So as you saw on my cell phone screen, you are not always going to make money. Like you don't know what is going on in the market, but you want to make money. So how do you know if the market is gonna go up or is gonna go down, right? There's something called technical analysis, and technical analysis is simply using past price data to try and predict future price movement, right? So when you are studying past price data, you want to see what has been going on in the market, and then from here, what is likely to happen in the future, right? Using the data that you already have in the market, right? So on our trade, it was of course a bad trade, but we didn't analyze, right? We just went there, we buy, we guess. That's exactly what new traders do, right? And most new traders, they'll just jump into the market, they'll just buy or they'll just sell, right? So we're going to talk about trends. We're going to talk about support and resistance. We're going to talk about candlestick patterns, right? So let's start off with what is called trends. What is a trend? A trend is the direction where the market is going, right? The market will either go up, down, or sideways. Three things, right? Whenever you go and open your charts, you are going to see the market will be either in this kind of a move, or in this kind of a move, or in this kind of a move, right? The market will go up, down, or in the sideway, right? So if you think about this, this is called an uptrend, right? This is called an uptrend. And how do you define an uptrend? An uptrend is simply when the market is moving upwards like this, like what have been happening here. The market has been moving upwards, right? If you go into much details, right, you are going to talk about things like higher highs and lower highs, higher highs and lower highs, right? So the market, okay, let me just do that just for a minute, right? The market moves like this. It makes what is called an impulsive move, right? And then a pullback, right? So we're going to label this I. an impulsive move and a pullback, right? In this impulsive move here, buyers are in profit, right? And after buyers make profit for some time, it's normal that people will feel like, okay, this price has been overpriced. Let's take out some of our profits. Or there will some people will think, okay, let's sell here because the price has been going up, 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 up. So we need to sell, right? So the balance between buyers and sellers in the market is what moves the market according to technical analysis, right? According to technical analysis, technical traders or all the retail traders, all traders like me, like you, if you are going to be a trader, we believe that if the price is going up, it simply means we have more buying demand, right? And if the price drops, now sellers are in control of that market, right? So we have an impulsive move here, and you have here what is called a pullback, I'll write PB, right? Then from there, we have another impulsive move, right? And we have another pullback, another impulsive move. And we create these zones right here, which is called higher highs. I'm not gonna go into much detail because I don't want to confuse here, but it's called higher highs and lower highs, right? This high here is higher than this one, so that's why it's called a higher high. And then this low here, so these are higher lows, sorry. This low here is higher than the previous low, so it's a higher low. So if this higher high is going up and up like that, we know that we are in an uptrend. So if you as a trader, if you had come to this market here and you see, let's say at this point, at this point, you were looking here and you're seeing, okay, the market is in an uptrend. So what do I do in an uptrend? I want to buy because I want to make money if the market keeps going up, right? So if you see this trend, this is an uptrend, and if you buy, right, because as traders, it's much better to follow the trend. So if you just bought here, after knowing the trend here, you would make profits when the market moves up because the market already have momentum, right? So in an uptrend, we are looking for buy trades because the market is already moving to the upside. Sometimes we can be looking for reversals, but it's as a beginner, the only way, the easiest way is to just go with the trend. If the market is going in an uptrend, you want to be buying, right? And then what is called a downtrend, right? So starting from here, going here, the market here was now in a downtrend. So what do you want to do? You want to sell. How do you know that the market is in a downtrend? You are seeing the market going below its previous reversal zones, right? Impulsive move, pullback. If the market breaks past this zone here, going down, we are continuing the downtrend. Now another pullback. We have this zone, and then if the market breaks down, so that's how you read a trend. But I'm not gonna go into details, as I said, because this is a big topic on its own. But just wanted you to know, how do you analyze the market? First, you need to know the trend. From here, the market was in an uptrend. From here, the market was now in a downtrend. So this is an uptrend. This is a downtrend, right? Now there's something called the sideways trend, right? The trend is when the market is not going up or down, but it's not going in a clear move up or clear move down, but it's just going up and down in a zone, something like this, right? You can see from this zone here to this zone here, right? The market was moving up, going down, going up, going down, going up. So as a technical trader, what do you do here when you want to trade? You wait for the market to come either to this point and then you sell, hoping that since the market has been reacting to this zone, it's going to react again. Because you can see from this point right here, when the market was going to this point, it was dropping, comes back again, drops, comes back again, drops. So when it comes back on this time, it's obvious that you are thinking you're thinking that this market is gonna drop. So you would sell here. As I said, if you sell, if the market goes down, you make money. So you see the market here, you sell, you make money. If you wanted to trade a buy trade in this type of a market, you'd look for a point where the market has been reversing on, right? So it comes back maybe on this time or on this time. You want to say, okay, if it has been bouncing on this level, there's chances that it's gonna bounce on this level. You will never know you are never going to be 100% sure, but you are going to be doing those things to justify your decisions, and you buy, right? If you buy here and if the market goes up, you make profit, right? Why do you want to buy here? Because you see that this market has been reacting on this zone, so it's likely again to react. If it does react, you make money. If it doesn't react, and if it goes all the way down, so now you are in loss, what do you want to do? You want to cut your loss early, right? And then look for another trade that will cover that loss and make you money, right? So that's what you do. This is called a sideways trend, right? So after knowing about trend, right? So as I said, this is technical analysis. I'm not gonna go in depth, but I just want to give you the overview of how it works. There's something called support and resistance that also helps you to analyze the market. So what is support and resistance? These are zones in the market where the market has been reacted to. As I was saying previously, right? If this market has been reacting to this zone, I know that there's chances that the market will react to this zone, right? So the market tends to respect these levels very much. Let me give you an example. If you look at this, you are going to see. If you look at this, you are going to see that if I draw a line here, and if I draw another line here, between these levels, you can see from this point, right? From this point right here, you see the market moved up. No, it even moved to this zone. So these zones, you need to know, it's not gonna be the exact lines, because this is a market of $6 trillion. This data right here, it gives you that the data of the zones, right? So from here, the market has been moving up, down, up, down, up, down, up. At this point right here, you are now convinced that if this market comes to this zone again, I will sell. Because why? Because I've been seeing this market reacting to this zone. And you sell. It drops, you make money. It comes back again, you sell. It drops, you make money. Maybe you are buying here or you are selling above here, but you can see that there are zones in the market where the market is always respecting that zone for a very long period of time, right? Maybe at some point it's gonna not maybe, but at some point it's gonna not react on the zone and breaks out and move maybe to the different direction, right? But if you manage to catch one trade here, one trade here, one trade here, one trade here, you have gotten four winning trades in a row before the market goes against you, right? So these zones here, these are the zones of support and resistance. So if I go into the market, let me open MetaTrader real quick on my computer, and you can see the reason why I chose to go to the phone at that point. I know that most of you guys are going to start off on your phone. Most of you are going to start on the phone. So I wanted to show you on the phone, but you can use this MetaTrader on the computer again. So I'm going to open it right now, right? But first you need to know this, okay. This is not a game. So I'll open the same Euro USD here. But as I said, the market, the current market is not moving because it's weak. It's already weakened today, but it will start move again on Monday, right? So if you look at this market, if I do this, you are going to look back and see that this is the data, right? This means this exchange rate was going up. Now here it was dropping. If you see this was going up. Here it was dropping. Here it was going up, right? So all the people who were buying here were making profit until at this point here, then it reversed. Some of the profits were some, so people who were selling here were now in profits. Now buyers in profits, right? And it goes all every day like that for 5 days a week and for 365 days a year, right? So I wanted to show you support and resistance here. So let me maximize this. You are going to see that there is going to be zones. So for you, your question is, how do I know exactly when to buy and when to sell, right? So you can use these zones to say, okay, let me mark out these zones like this. Let's say, let's do this. You're going to see something interesting right here. If I mark my zones, right? This is how I mark my zones, right? I don't draw lines on my charts because these are zones. These are not lines, right? So these are zones. These are not lines. You are going to see that. So I'm just gonna mark here. I can go all the way marking out these zones, but it's the same. You are going to see that most of the time, wherever the market have reacted to, it will likely react to again in the future, right? Wherever the market have reacted to, so what is going on here? Wherever the market have reacted to, it will react to again in the future. So here you can see the market drops. So I'll start off here. I just want you to pay attention to these levels that I've drawn. Here the market comes to this point and moves up, reacted here, right? It comes back. What it does it do when it comes back? It reacts again on this same level. It goes up. It breaks it. It comes back. It reacts again on this same level, dropping down. It comes back here. It did a lot of reaction here, but didn't drop, and then it breaks up to the previous level. Remember, the market reacted here. Now it drops again, went all the way, reacted to this zone because it have reacted to before, and then now it comes back to this same zone again, reacts again, and now breaks going up. So this is the current market of what is happening in the market right now. So what is the first thing that you think of when the market comes back to this zone? What are you thinking of? I'm thinking the market is gonna react again. So what do I do? Maybe there's two things that are gonna happen. The market will either drop here because it has been reacting to this market because it reacted once and now it reacted again. So now I'm thinking the market will likely react and drop again. So I will be looking maybe to sell here and expect prices to drop, right? So I will place my sell trade and then expect prices to drop. Why placing my sell trade here? Because I've been seeing this zone, the market reacting to this zone before. So I have confidence that it will likely react again to that level, right? So these are called levels of support and resistance. You also have to sometimes you also have to combine different things, like first knowing the trend, then combining it with support and resistance, right? Like building strategies, right? And I'm not going to talk about those right here, but you guys, I think Emmanuel will provide the link to my channel. You can come by and watch. There's a lot of videos like this type of videos on my channel. This is the type of videos that I make, right? So what a candlestick chart is, once you know the trend, right? You know support and resistance, and there's something that I need you to understand, which is called candlestick chart. What is a candlestick chart? It's a visual representation of price, right? So let me show you this. I was showing you these are called candlesticks, right? So let me explain them using this. On the open of when you go here in MetaTrader, and if you go to time frame, right? If I right click here, go to time frames, you're going to see this 1 minute, 5 minute, 15, 30, 1 hour. If I go and click 5-minute time frame, it means I'm now analyzing this market based on the data of what has been happening after every 5 minutes. So it takes 5 minutes for each and every one of these candles to be created, right? If I go to the daily time frame, now I'm using the daily. The reason why I'm telling you that is because when you come to this candlestick chart here, you are going to see that we have the open. So let's say this was uh, a, let's say a 1 hour or a 1 day time frame. So this candle will represent 1 full day, right? So the open of the candle, which is the opening price of the exchange rate on that day, is going to be the starting point of the candle. And then if the price is moved low to any point like this, it's gonna be the low of the day. And then we have the high of the day, which is the highest point where the price got to on that day. And then the closing price is the closing price of the day, right? So let's go back to MetaTrader real quick and I will explain this. So I'll use any candle here. Let's just pick this one. So on the opening of this so this is the 5 minute time frame. Let's go to the daily so that you can really understand easily. On the start of the day, right? On the start of the day, the market opened on this point here at this price, right? And it went all the way up to this point, to this price. And then it closes here at this price here. It's not written, but that's where it closes, right? So if you had bought on the opening of the day, at the close of the day, you would be in profits because the price is higher than its opening, right? But why do we care about these numbers? Let me explain to you why we care about the opening, the close. It shows you how the market has been reacting, right? So we have the bullish candle. If the opening price is low and the closing price is high, this is called a bullish candle, which means on that day the market was going up, or on that 5 minutes, if you are trading on a 5 minute time frame, on that 5 minutes, right? On the other side, we have the bearish, and if you notice, we have red candles and green candles, right? You can change whatever color you want, but basically these are the first ones, right? So if the opening price is higher than the closing price, what it means what the price was going down. So sellers were in control on that day or on those 5 minutes or on that 1 hour, depending on your time frame, right? So knowing this is very important because you are going to see that at some point we are going to see some of the candles which looks like this, right? You have a candle which has this kind of a shape. What does it shows you? It shows you different things, right? So first of all, you need to understand this is called the body of the candle, and then this is called a wick of the candle, right? So the body of the candle related to the wick of the candle can also help you to kind of predict where the market is likely to move, right? So I will show you an example here. So the market opens here and closed here, as I said, right? The opening price, if the candle is green, this is the opening price and this is the closing price. So the market was pushing up, but there is a long wick here, right? Which shows you the low. What does this show? It shows that when the candle opened here, it went all the way down. And then at some point during that day, the market was pushed all the way up. So this one here is called a rejection. It shows you, okay, the market has been rejected to go down. Now it's likely to go up. So you are seeing this as a trader and you are thinking, okay, if this market was rejected to go down, what is most likely to happen? Maybe it is going to be to keep being pushed up because it tried going down and to this lowest point, and then it was the market rejected, right? So which means maybe sellers, buyers feel, okay, this price is underpriced, let's buy, and then maybe they win the battle and the market will go in another direction, right? So if I go to the market, okay, let me go to this, and you are going to see that on those zones where I was talking about support and resistance, right? You can also add things like these candlestick patterns to predict, okay, this market has been reacting to this zone, and on this zone, since this market has been reacting, I'm also seeing that there's candlesticks with long wicks right there. But so it simply means, okay, maybe the market have managed to this zone have managed to push prices lower, because this is, of course, the market was pushing down. This is a downtrend, of course. Now on this zone, I see there's a support zone. There's also rejection, so prices are likely to drop down. So that's the kind of analysis that you will be doing, right? It's very important for you to have a strategy and things to follow in the market. But basically, if you understand the trends, if you understand support and resistance, and if you understand this candlestick pattern, these are three different topics that I just kind of gone through here in few minutes, right? So this is not super in depth, but there's a lot of things to learn here, because candlestick pattern can be a topic on its own. There's also support and resistance trends. You need to understand these things, right? So if you decide to go forward and be a trader, you need to understand this, right? So let's do a quick recap of this whole thing and understand what we're going through, right? So Forex, what is Forex? Is the foreign exchange, which means buying and selling currencies to make profit, right? And how do you make money as a trader? You make money by either buying low, buy when you think the price is gonna go up, right? So if the market is moving like this, and you feel like, okay, the market is gonna keep going up, you buy maybe at this point. If it keeps going up, you make the difference between your buying point and your selling point, right? So what is a pip? A pip is the 40 decimal number on an exchange rate, and it's the smallest movement that a currency pair can make. So let's say the market moved from 1.2020 to 1.2035. How many pips have this market moved with, right? This market has moved with, we're just going to put 5 here and 1 and then 0, 0. We are subtracting here. Remember, we are subtracting 1.0015. That's 15 pips, right? And how much? Okay, this is 0. How much is 15 pips in dollars? Now it depends on your lots, right? It depends on your lots, because we say pip value, or the number of pips is called, is the pip value, the money that you make or lose per trade. We say your lot size, right? Whatever lot size you choose to place, right? On my trade, you see I chose the smaller lot sizes. So when the market was moving up and down, it was going with like -20, -40 cents, -50 cents. But if you place big trades, you are going to be having bigger movements and bigger losses or profits, right? So lot size times the pip is what is gonna give you the pip value, right? So a broker is a company that is gonna be connecting you to the market, right? And for you to get a good broker, you need to look for things like experience, leverage, customer reviews, customer services, payment methods, and also, is the broker common in your country or from other traders? Because you just don't want to go with a broker that you don't know, right? So we are doing technical analysis. You're going to use trend lines, support and resistance, and candlestick patterns to analyze the market, right? These are the three core things that you need to understand. Trends, support and resistance, and patterns. All the strategies that you are going to build, all the different strategies are going to be around those three things: the trend, the support and resistance, and the candlestick patterns, right? Because these are the three things that are going to teach you, okay, to show you the market has been moving like this, and now it's likely to move in this direction based on those things, right? So
I believe we'll have the recording. Then anybody that needs to go through it again, we get the
Yeah,
recording, and then you
yeah.
can just watch it and catch up. Also, you can just subscribe to Courage's channel. I'm going to leave the link after now. On his channel, he has a lot of forex trading tutorials that will help you understand more of these concepts more. So
Yeah, we have like 168 videos now on
yeah,
Forex Trade. On,
so you can just go over to that channel and yeah, a lot of resources there. It has a lot of resources, and I think you have a number of forex trading courses, right?
actually, when it comes to courses, I don't have courses. I have one. I have like a training program which when someone wants to join, we just take you for 6 weeks. We do group every week. We do live sessions on Telegram, and
Okay.
also I give you a course for free and some tools that you can start using. So that's only the thing that I hear that I would say, okay, if you want to check it out, I can give you the link so that you can check it out. It's a 6 week training program. That means I will be with you for 6 weeks, and you can call me at any time. You can schedule the call, and we can talk about what you need to understand. I think basically that's what we have. Only that's only the only thing that we have.
Awesome. You can send me the link to that. Then I'm going to paste it in the chat.
It's okay. So let me try to think about some questions that people ask me mostly when they get started, right? So
Awesome.
the first thing is like people will say, how much do I need to get started? Okay. So if I manage to explain this to you, when I was talking about leverage, I was trying to say you can start because the brokers allow you to deposit most of them from $10, right? So you can start from $10, but what you need to do is you need to understand that if you have only $10 in your account, the profits or that you are going to get is going to be directly added to your account, or the losses that you are going to go through is going to be directly affecting your account. So you need to start small, and you can start off by placing like risking like $2, $3, $1, something like that, right? But if you have a bigger account, you can also risk more. But you can start small. But when you start small, don't expect you don't need to you don't have to expect that you can put in $10 tomorrow, and then after like 1 day or 2 days you already have $500. It's not gonna happen like that, unfortunately. In the forex trading industry, that's what most people uh, say, or that's what they believe, because the opportunity of making money as fast as possible is there, but also the more you try to make, the more you are risky, right? You have
Yeah.
to understand that, because people whoever is talking about forex trading out there, I think most of them, especially on Instagram, they're trying to make people believe that with forex you can. People ask me, one of the questions that I get asked the most is, what kind of a car do you drive, or do you own a house, do you own the things?
Yeah.
Then I told you I've been trading for like from 2018. That's when I started knowing about trading. But I think I started driving maybe last year, towards the end of last year, right?
Wow.
Because the thing was, you can make $1,000 today, but if you don't know what you are doing, you can lose that $1,000 in the next day.
Yeah.
So it's the amount of risk, the amount of the potential of making money as fast as possible is there. You can make thousands of dollars in seconds. But think about if I make $1,000, there's also chances of losing a thousand
Yeah.
bucks, right? Because the market is always moving up or down. At any point, it doesn't stop. It's always moving up and down. So if it's moving up, if you are buying, if you are in profits, fine, you are making money. But if it's moving against you, you are losing the same amount of. Whenever you have a potential to make $100, you can lose $100 at that same point, right? So people always ask, oh, how much do I need to start? You need to start small. Start on a demo. The demo account is free. Start on a demo, you practice, and then when you put in your real money, start small. Don't risk. And also, the other thing is, don't trade. Don't try to be to to people who do something like borrowing money to trade. It's the worst thing that you can ever do. And people always come and say, I borrowed money from someone, so now I need to pay back. So can you teach me how to trade and make this money back?
Yeah.
Man, it's not gonna happen like that, because there's gonna be a lot of emotions involved in this. And if you are
Yeah.
trading money that is not yours, some it's the money that you cannot control yourself, so the chances of losing will be higher at that point, right? So that's some of the questions that I get. And also, people also need to know things like, how much can I be risking per trade or something like that. That would uh, firstly, that will depend on your account size. For me personally, there's an account that I risk like $5 or $10 per trade. There's another account that I can risk $50 per trade. There's another account that I can risk $100 per trade. But you need to understand that all these accounts I risk different amounts of money. And and I'm talking in terms of risking, because it's risky. Okay, it's risky because the profits are there, potential profits are there, but I don't want people to believe that I can go there tomorrow and make a lot of money. There's a learning curve. There's a lot of things that happen. But if I'm risking $100 per trade, I'm also trying to make $200. So at the end of the day, after a long period of time, I can be in profit. And maybe after a day, maybe I'll place 10 trades, win five, lose five, or win six, lose four, or win seven, lose three. And then at the end of the day, I'll try to make sure that my account is in profit. If it does lose, it does lose. It happens. But what I'm saying is, your account size, if you have $10, you can't risk $10 per trade, because that way you only have one chance, right? But if you have $100, if you risk $10 per trade, that means you have 10 chances, right? So it depends on your account. But my best recommendation is, always try to start small. Don't rush and try to make thousands of dollars in a few minutes. It's not gonna happen like that, right?
Yeah.
So I think those are some of the questions that people have. But I think maybe if the people were going to ask the questions for themselves, but I'm just trying to come up with some of the most common questions that I get almost each and every time, right? So I hope that
All right.
is that.
I can drop your WhatsApp number in the chat as well, so that if they want to ask you any question, they can just message you on WhatsApp, right?
Yeah, that would be cool.
Awesome. Awesome. Thank you so much for your time. Personally, I've learned a lot. As a matter of fact, I've been writing down a lot of stuff here. Thank you so much.
You are welcome. You are welcome. Thank you for the opportunity of letting me be here. So I'll try to. So I have the recording. So soon after, I will just forward you the recording. Then
Yeah,
maybe you can also share on YouTube or something.
exactly. All right, man. Thank you so much for coming. Thank you for your time. And we'll talk on WhatsApp.
Okay, fine. So I'll go through my my caffeine, but I think I managed to have to maintain the energy.
Yes.
Man, I'm
Yeah,
going to, I'm going to go to sleep right now soon after this.
you did extremely well. So thank you so much, guys, for coming. We have about 12 people online right now. Thank you so much, guys. I hope you learned a lot. If you have any questions, I'm going to leave Courage's WhatsApp number. You can just contact him and talk to him directly. With all that said, have a great night rest, guys.
Okay, thank you so much.